Man, if you're an investor today, the number of choices out there is just overwhelming, right? Do you play it safe with the stuff that's always worked? Do you chase those massive, once-in-a-lifetime gains? Or do you try to get clever with some kind of complex trading system? It feels like a gauntlet. So today, that's what we're going to do. We're going to cut through all that noise and compare 3 totally different ways you could invest your money.
Okay, let's just dive right in. Look, the modern investment world, it's a mess of data and hype and a million different strategies. Our goal here is pretty simple. We want to give you a clear map. We're going to put some of the most talked about approaches right next to each other so you can see for yourself how they really stack up.
So here's the big question we're really digging into. Are you better off with the slow, steady income you get from a solid dividend fund? Or maybe the explosive, super high-risk potential of something like crypto? Or is there an active trading strategy, a system that might just give you a hidden edge? We've got 3 contenders, all with the same goal, making your money grow. Now, before we can really judge these contenders, we need a baseline, right? We need that solid, reliable champion that we can measure everything else against. And for this showdown, our baseline is going to be one of the most popular dividend ETFs out there, a real classic in the world of income investing. So say hello to SCHD. The easiest way to think about it is like this. It's a single basket that holds about 100 of the most reliable dividend-paying companies in the U.S. So you're not just betting on one horse. You're spreading your bet across a ton of established businesses that have been sharing their profits with investors for a long, long time. It is the definition of the slow and steady approach.
And here is our benchmark number. Over the past decade, if you had just put your money in SCHD and reinvested all those dividends, you would have seen an average return of 12.27% per year. That's a solid, totally respectable performance. Okay, now I want you to burn that number into your brain because things are about to get really interesting. All right, let's bring in our first contender. This one comes from a completely different universe. We're leaving slow and steady in the dust and jumping headfirst into explosive growth and a huge bet on the new digital frontier. Of course, I'm talking about Bitcoin.
Just look at that number, a 10-year annualized return of over 66%. Remember SCHD's 12%? This absolutely blows it out of the water. I mean, on paper, it looks like a no-brainer, an absolute slam dunk. But as any investor will tell you, returns like that, they usually come with a pretty serious catch.
And this slide tells that story perfectly. Just look at the line for Bitcoin. You've got a 300% gain one year, 155% another, but then smack in the middle, a 64% loss. It is a violent roller coaster. Now look at SCHD's line. It's like a gentle wave by comparison. This right here is what volatility looks like in the wild. So this is the question every single crypto investor has to answer for themselves. The growth is amazing, no doubt. But are you truly prepared for the ride? The price you pay for those huge gains is the potential for equally huge stomach-churning drops. And this chart just lays that cost bare. A drawdown, that's just a fancy word for how far something has fallen from its peak. At its absolute worst, Bitcoin has lost over 85% of its value. I mean, just try to imagine watching your money evaporate like that. Now, SCHD's worst drop was about 33%. Both are painful for sure, but they're in completely different universes of risk. Okay, but here's where it gets really weird and kind of counterintuitive. This is the Sharpe ratio. It's a key metric that basically measures your return after you account for all that risk and volatility. Think of it as your bang for your buck. A higher number is better, and you can see, even with its insane ups and downs, Bitcoin's Sharpe ratio over the last decade is actually higher than SCHD's. What that means is its returns were so massive, they more than made up for the wild ride. It's a pretty fascinating result.
Okay, so we've looked at a classic buy and hold dividend fund. We've looked at a buy and hold digital asset. Our next contender is totally different. It's not about what you buy, it's about how you trade. This is an active strategy that tries to systematically find an edge and beat the market.
So the whole idea behind it, as financial analyst Ryan O'Connell explains here, is something called mean reversion. The theory is actually pretty simple. Sometimes the market just overreacts. A stock gets totally hammered one day, maybe way more than it should have, which means it might be due for a little bounce the next day. This whole strategy is built to catch that little bounce, day after day after day.
So what does this actually look like in practice? Well, every single day, at the close of the market, you find the 10 biggest losers in the Dow Jones. You split your money evenly across all 10. You hold them overnight, and the very next day, you sell all of them,
and then you do the whole thing over again with a new list of losers. It is an incredibly active, intense way to invest. So the big question is, does it even work? Well, according to a 10-year backtest, yeah, it seems to. This strategy generated a 16% annual return, which beat just buying and holding the Dow at 13.3%. Now, it was a little more volatile, you can see that, at 20% versus 17%, but because the returns were higher, it ended up with a better Sharpe ratio, meaning it gave you better risk-adjusted returns. But, and believe me, this is a huge but, we gotta be realistic here. This is a backtest. It's a simulation. It doesn't include things like transaction costs, which would add up really fast if you're trading every single day. And it definitely doesn't account for the massive tax bill you'd get from all those short-term capital gains. In the real world, those two things could easily wipe out that extra performance. All right, on to our final contender. This one tries to have it both ways. It wants to blend the stability of a fund like SCHD with an extra layer of income by using some pretty complex financial engineering to try and juice the returns. And this is it, the DDD ETF. Its whole goal is pretty much right there in the name. At its core, it just holds SCHD and collects those nice, steady dividends. But then it adds another layer. It uses an option strategy to generate extra cash, or premium. And its target is to generate enough extra cash to double the dividend that SCHD pays out. It's kind of like taking a reliable engine and trying to bolt a turbocharger onto it. So how does it make that extra money? It uses something called a covered call spread. Let's just simplify that. The fund owns SCHD. It then basically sells the right for someone else to buy those shares from them at a higher price in the future. For selling that right, the fund gets paid cash right now. That's the extra income. The catch? Well, if SCHD's price skyrockets past that level, the fund's gains are capped. It doesn't get to participate in that big rally, but it does get to keep the cash it was paid up front. And that, of course, brings us to the risks. Because that extra income is not free. Capping your upside is a big one. You'll miss out on the best days in the market. But here's the really crucial one. Sometimes the money they send you is just a return of capital. That means they're not sending you profits. They're literally just giving you your own money back and calling it a yield. It feels like income, but what's actually happening is your initial investment is shrinking. It's a very complex product with some very real risks hidden inside. Okay, we have officially run the gauntlet. We've seen the steady baseline, the high-growth rocket ship, the hyperactive trader, and the complex engineered hybrid. So let's put them all on one final scorecard to make this choice a little bit clearer. So let's just put it all together. You've got SCHD, our baseline, low complexity, moderate risk, and its main goal is just steady income. Then you have the total opposite, Bitcoin. Its goal is hypergrowth, but it comes with very high risk. In the middle, you've got that mean reversion strategy. It's aiming for outperformance, but it requires a high tolerance for risk and a ton of hands-on work. And finally, you have the DDD ETF, trying to give you extra income, but bringing high risk and very high complexity along for the ride. So at the end of the day, there is no magic bullet here. There's no single best answer for everyone. The right choice depends completely on you. Are you someone who wants simplicity and a reliable check? Can your stomach handle extreme swings for a shot at life-changing growth? Or are you willing to take on complexity and hard work for a potential edge? It's your money and your goals. The question is, which one of these fits your playbook?